Hi, my name's Warren Dueck, and I'm here with my colleague Stephen Flynn. We're both in the Vancouver office. Good morning, Stephen.
Hey, good morning, Warren.
We're going to talk about business ownership for Americans resident in Canada. Now, our focus here is on U.S. citizens resident in Canada, but that can also, in certain cases, include people like green card holders or other people who are residents of the U.S. Under U.S. tax law. This is a big subject, actually, and it's a constant problem for U.S. citizens in particular living in Canada because they're subject to worldwide tax on both their U.S., both in the U.S. and in Canada. So in order to get a win, you got to get a win on both sides. You win the lottery, you avoid Canadian tax, but you're still subject to U.S. tax. So the problem becomes more acute for business owners in Canada because of the nature of both the US Canadian tax systems, which are similar, but when they're different, they're really different. And that's part of the problem here. So we're going to talk about this area. There's a lot of conflict here, and we're going to try and steer you through this. This is going to be a tax 101 level. So we could spend days talking about the subject, but we're going to spend about an hour on this with your questions. So there is time for questions. Please write them in. You can send them directly to us, and we're going to answer them at the end. We do want your participation. It makes this more interesting because we're dealing with issues that are relevant to you. There's also a survey at the end of the program. We'll send that to you after you sign out. And we do appreciate your comments and thoughts. That's very helpful to us. And lastly, if you want to view a live transcript, you can hit the CC button on your screen, and you can actually get a transcript of the subjects we're going to discuss. Now, we're going to cover a variety of areas here. Again, these subjects are huge ones, so we're not going to be able to cover everything here, but we're going to try and hit the highlights for you. And particularly if you're looking at forming a business entity in Canada, or you have one and are kind of want to understand the issues that apply to it, we're going to cover those areas. The first comment I'm going to make is about entity strategies. And there's really two primary reasons why people choose to use an entity. And principally that means a corporation. Though there's definitely other entities, and we'll talk about those too. One is to defer tax. And, when you've got a 54% tax rate in British Columbia on individuals, and you hit that at about $230,000 or 48% in Alberta, tax deferral is a big deal. When in a corporate entity, like a Canadian corporation, you can pay about 11% tax on the first $500,000. So tax deferral is huge, and in Canada we incorporate everything. But the big issue there is, can you defer tax? And secondly, can you limit your liability? Now, liability is really not a tax question per se. That's a legal issue. We're going to cover it, but this is a good subject for your legal counsel to talk to you about in terms of what are the limitations on liability associated with different entities.
It's interesting, Warren. One of the third reasons we used to always see for Canadian residents for primary reasons was something called income splitting, something that for U.S. citizens would be a little bit foreign to them, because in general terms, a married couple can file a joint tax return and we don't worry about splitting income. But in Canada, everyone files their own tax return. So a lot of business owners would use Canadian corporations to split income so that the lower income spouse could receive dividends and take advantage of the low marginal tax rates to lower the family's overall tax liability. 5 years ago, Canada enacted something called the Tax on Split Income Rules, or TOSI rules. You hear that a lot. That has taken away a lot of those advantages to split income. Not completely. There are certain exemptions you can still use, but a lot of that planning is a lot more difficult to obtain.
Yeah, that's excellent, Steve. That's true. Income splitting is part of that whole tax picture and ways that you can save overall between spouses. I just want to touch base on limited liability. Now, of course, that's a it can be a big deal, but corporations can't generally be used to limit liability for professionals. So lawyers, doctors, engineers, architects, accountants, a whole wide range of group of people cannot use a corporation to limit their liability associated with their professional services. Again, that's a legal question. We're not giving legal advice. We're just going to be talking about tax issues. There are secondary reasons. A lot of people think that you must incorporate, that it's a business necessity to do that in order to claim tax deductions. There's no requirement that you actually use a corporation to conduct a business activity. There's lots of good reasons to do that. And those can even include ease of use. I mean, banks and lenders, advisors, suppliers are all, mostly work with corporate entities, but that's not a requirement to do that. Certainly not for tax reasons. Also, record keeping can be simplified by using a corporation or another entity, because you create a separate tax person there that can account for, as opposed to saying it's a sole proprietorship. So I'm going to pass this next slide over to Steve, and he'll talk about business formation.
Sure. And one of the things entrepreneurs, as they try and continue or start their business, is oftentimes there'll be an existing business, there'll be existing assets, and they'll want to contribute those assets to the newly formed entity. And so for Canadian tax purposes, when you take an asset, whether it's a tangible asset, an intangible, something that's appreciated in value, in general terms, you can make specific elections under Canadian tax law, and that transfer is done on a tax deferred basis. So long as you take the asset, you contribute to the corporation, you receive shares in return, there shouldn't be any Canadian tax, even though there may be an unrealized gain or appreciation on that asset. For US tax purposes, the result may be very different. For a US citizen who, again, subject to US tax on their worldwide income, oftentimes these transactions do not qualify under US tax law for any kind of deferral treatment, and as a result, could result in US taxation on any appreciation. So it's a lot of those differences that Warren talked about between the two countries that we're always mindful when we're using entities for US citizens resident in Canada.
So Steve, if I was going to start a business and I was going to, start a farming corporation or something like that, and I've got land that's appreciating value, I can transfer it in tax free for Canadian purposes. And the US answer is more nuanced. It depends on kind of the nature of the activity, ownership interest. These are very complex rules here associated with the US tax provisions, because any transfer by a US person to a non-US entity has its own separate set of rules.
And definitely beyond a tax 101 type presentation like we're doing this morning. Some of the other strategy we look at when it comes to making investments or advancing funds to the Canadian entity, oftentimes from a Canadian tax perspective, we'll put in capital, but we'll make what's called a shareholder loan. We'll take our own money, we'll put it into the corporation. We can leave it there as a way to take money out of the corporation later. We don't have to charge interest from a Canadian tax perspective. It can sit there, and it represents, from a Canadian tax perspective, a good strategy to be able to, down the road, take money out of the corporation on a tax-free basis. And so while that's a good Canadian tax result, from a US tax perspective, again, as Warren suggested, nuanced and very more complicated, the US really doesn't have that kind of concept of an interest-free shareholder loan unless there are market terms to any kind of investment in the corporation, which would count an interest rate that represents market rates, principal repayments, a term sheet. It's going to be equity. It's going to be share capital. And as a result, from a US tax perspective, those withdrawals from the corporation go through something called an earnings and profits calculation. And if you have profits in the years, the withdrawals from the corporation won't be a return of principal on the loan. It'll be considered a taxable dividend for US tax purposes. And so again, very different treatment between US and Canadian tax law can get very different results.
Steve, if I can just highlight these sort of differences in terms of investment strategy. I mean, it's not uncommon to see a Canadian corporation that has like $1,000 of share capital and, $10 million shareholder loan or $1 million shareholder loan. That's absolutely inconceivable in a U.S. context. And, that in a U.S. context, the share capital must reflect the capital needs of the business. And typically, I mean, the traditional safe harbor in the U.S. has been you couldn't have more than a 3-to-1 debt equity ratio. So if you had $1 million of, debt and $1,000 of share capital in a U.S. context, you'd have to have at least $250,000 of share capital. And otherwise, you risk that treatment where you'd end up with that loan, which would still have to have market terms associated with being treated potentially as equity capital. And a tax-free repayment of the loan would be a taxable transaction potentially for U.S. tax purposes.
Excellent. Yeah, so those are some of the differences between business formation when we're looking at U.S. citizens in Canada forming Canadian entities. I'm going to turn it back to Warren to talk about some of the U.S. anti-deferral regimes.
Yeah, now this is where life gets a lot more complex. Anytime there's a special word in tax law, Steve used the word earnings and profits. That's a defined term under U.S. tax law. All the headings here: controlled foreign corporations, passive foreign investment companies, and the best one of all, I think, global intangible low taxed income, GILTI. That was a Trump provision. Anytime you have a special word like that, there's a problem. And U.S. tax law is very much focused on preventing U.S. persons, that includes a U.S. citizen or a green card holder, if they're going to own interest, and that's entirely legal to own interest in a non-U.S. entity, they must make certain disclosures associated with it. These are not the obligations of your corporation. These are obligations of you, the taxpayer, if you're a U.S. citizen or resident. And so each of these provisions try to prevent you from putting your income offshore. And while the focus is typically on investment income, it's not limited to investment income. I'm going to group the top and bottom one together here: controlled foreign corporations and global intangible low taxed income. These rules basically apply when more than 50% of the shares, either in votes or value, are held by U.S. persons. And there's a broader definition of what that means and who's a qualifying shareholder and things like that. But where you have a U.S. citizen owns 100% of a non-U.S. entity, it's going to be a controlled foreign corporation. And it's going to be subject to both the controlled foreign corporation rules and also the global intangible low taxed income. I'm going to talk last about the passive foreign investment companies, but in the controlled foreign corporation structure, what happens is income would be attributed to the U.S. shareholder for U.S. tax purposes, but it won't be taxable to the shareholder for Canadian tax purposes until it's actually distributed. So there's a real risk here of double taxation. And this is where that timing issue becomes really important, that you need to try and match the result in Canada and the U.S. And that's, candidly, a lot of times we'd like to think we're playing offense with tax strategies. At least some part of the time we're playing defense. And this is one time we're doing that, is we're trying to avoid getting in a worse situation. So controlled foreign corporations result in attribution of income. Essentially, the same thing is true with global intangible low taxed income, in that the income would be treated as being earned by the U.S. Shareholder. And there's some restrictions on foreign tax credits, as noted on the slide there. These two rules create a lot of problems. We've identified passive income associated with them, but they both have circumstances where active business income can be subject to these rules, particularly with respect to the GILTI rules. So these are problems. They can be managed. They're not the end of the world, but someone has to be paying attention to this subject.
Well, and I think when you look at, there's a lot of information on this slide. I think Warren said it best, where he said, we're trying to hit this at a high level this morning. If you wanted to do a bit of a deeper dive or an understanding into the middle category there, for example, passive foreign investment companies, you're welcome to go to our YouTube channel. We did a webinar on this very subject, I want to say within the last month, where we talked a bit about what a passive foreign investment company was, what some of the problems are, but more importantly, what some of the solutions are to try and handle that. It's probably out of scope for this presentation, but you're welcome to go to our YouTube channel and find that webinar. If you aren't sure where to find that, you can contact us and we'll send you the link.
Thanks, Steve. Yeah, passive foreign investment companies commonly referred to as PFIC, P-F-I-C. They result in a higher tax rate. The big trick here on PFICs is there is no minimum ownership. With regard to the controlled foreign corporations and GILTI, both of them require at least owning 50%. With passive foreign investment companies, there's no minimum ownership. So if you own 0.1% of a non-US corporation that qualifies as a PFIC, you've got a PFIC issue to deal with. And there's some adverse tax results there. As Steve mentioned, our YouTube video actually talks about some of those solutions to those. And PFICs are really easy for example, a husband and wife team where one's a US citizen, one's not. They both have 50% share ownership interest. And their company, for example, is a professional corporation or something like that, where they've got a couple of chairs, a desk, and a computer, and they've got $500,000 sitting in investments. That's going to be a PFIC by definition in most cases. So these anti-tax deferral regimes try and stop people from, in effect, putting money offshore. You say, well, I'm not putting money offshore, I'm putting it in Canada where I live. Well, from a US tax law perspective, you're outside the US, you're offshore, it's a foreign corporation, you fit in these rules. So Steve's going to talk a little bit more about some of the entities available to you.
Sure. So from a Canadian perspective, and we'll talk in terms of a US citizen resident in Canada, if they're going to conduct business in Canada, and that could be themselves providing services, they're selling product, it's Canadian customers, they got Canadian employees. In general terms, you'd probably want to consider a Canadian corporation. There's two types of corporations here. There's just what are called just standard or regular Canadian corporations. There is something that's available in 3 different provinces in Nova Scotia, British Columbia, and Alberta called an unlimited liability company. And Warren's going to talk a little bit more about what the advantages are for US citizens to use something called an unlimited liability company. So I'll leave that for Warren. For US purposes, then, if you take the same US citizen resident in Canada that perhaps wants to do business in the US, it could be real estate development, it could be they've got a partner in the US and they've got an online business, they've got some intellectual property they're trying to develop, it may make sense to consider a US corporation. The choices are a little bit more. The US has a number of different types of entities. You form something called a C corporation or just simply a regular corporation under US law. Those are typically subject to a tax rate federally of 21%. You often see C corporations used in a high-tech environment where there can be some pretty attractive provisions under US tax law to have capital gains tax-free for US tax purposes. Wouldn't be the same for Canadian tax purposes, but oftentimes if you're a US citizen resident in Canada and you're doing business with US partners, they may want to have that set up. That may be very advantageous to them. There's also something called an S corporation. This is a regular corporation under U.S. law that makes a specific election under U.S. tax law to be treated as what's called an S corporation. It's really a flow through. So it's got the advantages of a corporation that it provides liability protection for the shareholders. But the tax advantage is that the corporation then itself doesn't pay any tax. It allocates the income, the expenses, the credits, all the activities allocated to the individual shareholders and taxed personally. We'll talk a little bit later about what that means for Canadian tax purposes. That can be an advantage to use an S corporation. There's some provisions there. One of the big ones for S corporations is that in general, every single shareholder needs to be a U.S. person, or in some circumstances, we can have some other entities that can allow some non-U.S. persons. We'll talk a little about that later. One of the entities we see very commonly is something called a limited liability company, or an LLC for short. And you see this very common used in the U.S. Again, provides liability protection for the members. It's a flow-through entity, so it's not taxed itself. The members are taxed on all the activity. They're easy to form. There's no need for a general partner. There's no restriction on how many classes of shares you can have or how many members you can have. And so they're very common. The concern we always have from a Canadian tax perspective is that Canada does not treat limited liability companies as partnerships or flow-throughs. Canada's got a very different tax treatment, and this has existed for 30 years or more, that because all of the members have limited liability protection, and because it acts like a company, it's got the word company in the title, it looks like a corporation, Canada treats LLCs formed in any jurisdiction in the US as a corporation. So you get a mistiming of, and a mischaracterization of income between the US and Canada. The US is going to allocate the proceeds, allocate the gains, allocate the income to the individuals to be taxed on an individual basis. Canada is going to only treat cash or distributions of assets out of the LLC as a dividend. And so they can, those two things don't have to happen in the same year. You can get mistiming of income, you can get mismatches of foreign tax credits. On an overall basis, when you run the numbers, using an LLC can result in taxation rates that can exceed 70% total between the two countries. Very difficult to manage. So we generally suggest to US citizens or any Canadian resident candidates looking in the US that they avoid using a direct interest in a limited liability company. Warren, some thoughts on LLCs?
Yeah, LLCs were the subject of a recent, change in the Canadian budget that focused on the use of LLCs. There was a planning mechanism where people had US LLCs that were resident in Canada, and they were not subject to Canada's refundable tax regime, which basically is used to prevent Canadians from using corporations to defer tax on investment income. And so those rules have all changed with regards to LLCs and other non-Canadian entities that are resident in Canada. One thing I'd say here with regards to US corporations, if you're a US citizen doing business in Canada, it's very rare that you actually want to use a US corporation to do that. We've kind of focused on the US rules associated with using non-US corporations, but Canada has its own set of rules for Canadians using non-Canadian entities, particularly doing business in Canada. And that's something called the Foreign Accrual Property Income Rules, or we like to talk in acronyms here, FAPI. And so if you hear someone say something about FAPI, there's a problem here. And so, generally, doing business if you're a resident in Canada using a non-Canadian corporation to do business in Canada, it creates its own set of problems here. And, you want to be very careful about that use. We'll switch through to pass-through entities here. And, basically the idea of a pass-through entity is an entity that the entity doesn't necessarily pay tax, but the partner or the owner pays the tax. Now, we'll make a distinction between these two. I say limited partnership and unlimited liability company, but a limited partnership, it's not actually taxable on the income, its partners pay the tax. And the advantage of limited partnerships, and generally all partnerships, is that generally they match Canadian U.S. income treatment and the timing of that income. Now, we use the word generally because that's not always true. Limited partnerships are used extensively, particularly in a real estate development, particularly Canadian investment in U.S. real estate development. But remember that all our rules aren't identical. They're similar. It's the differences that count. And the one that I'll just bring to your attention, for example, is in the U.S. you can make an installment sale, and you can make it over an unlimited period of time. The individual pays tax, or whether it's a partnership or an individual, they pay tax in the U.S. when cash is received. But in Canada, and that could be over 20 years or 30 years, but in Canada it says you have to accrue all that income over 5 years. So if you have a 20-year installment sale contract, Canada's going to force you to actually recognize that income in 5 years, even though in the US you might recognize it over 20 years. So again, we say kind of generally they match up. So you still need to be careful with details. Transfers to a partnership are taxable for Canadian tax purposes, unless all the partners are resident in Canada. So if you got a partnership of 5 people and one of them happens to be in the US, for Canadian tax purposes, it is not a Canadian partnership. And therefore, if you contribute land that's appreciated in value, you're going to end up with a Canadian tax, even though you're a Canadian resident. So all the partners need to be Canadian residents. And that's a common rule. I think you'll see that generally in drafting agreements will say, do you want to make sure that all your partners are Canadian residents? So limited partnership is, it can be a very effective tool. The problem is they're not really great as business entities. They're great for real estate in particular, and quite common in that regard. But they have some issues there in that limited partners cannot be active in the management of the company. So that's a problem. Steve, I don't know if you had any other comments on limited partnerships.
Well, I'll talk a little bit more about limited partnerships from a U.S. perspective later.
Sure. Unlimited liability companies. Now, this is where things get really interesting, because for Canadian tax purposes, an unlimited liability is taxed and treated the same as a regular corporation. For U.S. tax purposes, if there's only one owner, it's treated as it doesn't exist as a separate entity. In other words, this ends up being a sole proprietorship, or commonly referred to as a disregarded entity. It just doesn't exist. So a U.S. person owning 100% of a unlimited liability company will be treated as though any activity in that ULC is undertaken as a sole proprietorship. Now, this is a great opportunity for people. When we have situations where Canadian and U.S. tax law look at the same thing, but come up with different answers, you can either have the best of both worlds or the worst of both worlds. So you have to be careful when you look at these. ULCs, though, one of the things that's attractive about them is they can avoid the U.S. anti-tax deferral regimes. If you have an unlimited liability company, you're not going to be subject to controlled foreign corporation rules. You're not going to be subject to GILTI, and you're not going to be subject to the passive foreign investment company rules either. So it avoids those traps. But remember, one of the key issues with an unlimited liability company is that it has unlimited liability. So if you're in a business that has a high amount of risk, that may not be a great solution. On the other hand, if you're a professional, we talked about this before, architect, accountant, engineer, lawyer, doctor, dentist, lots of other categories too. You can't use an entity to protect you against unlimited liability because you're always liable for the activities that the professional activities you and services you provide. So generally the big issue with ULCs is saying is, if you're a US person, is would your professional organization or association accept that as a valid corporate entity? And there's been a lot of pressure on organizations. There's been a fair amount of resistance. You'll have to check and look to see if, depending on your profession, as to, would they allow you to do that?
They're interesting entities. You may even wonder, like, why would something like this exist? And if you look at some of the history, unlimited liability companies go back to British legal concepts back hundreds of years ago. Nova Scotia's had this legislation for probably over 100 years. It's a fairly recent change in provincial law in Western Canada. Alberta and British Columbia introduced unlimited liability company legislation in 2004, so it's within the last 20 years. If you look at the British Columbia reasons on their government website as to why this exists, it's just got one sentence. It says, for US tax purposes. That's the only reason British Columbia introduced this, is they saw a lot of American companies investing in Canada using this, and BC and Alberta wanted a piece of that. So
yeah, that's interesting, Steve, because the funny part about these rules, until BC and Alberta brought in these rules, the only province in Canada that had them was Nova Scotia. And I think they were charging like, the province itself was charging like $5,000 or $6,000 to form these entities. That was the formation fee. I'm not sure what it is in BC right now, but I think it's under $1,000. So
it's a lower cost in the two provinces in Western Canada, but it's a more modern legislation. All sorts of things under Nova Scotia law had to be done through court-appointed approvals. This is more legislative or more form-based, and so it was a lot more modern legislation that they introduced.
yeah, the Nova Scotia law went, actually, I was going to say the Middle Ages. That's probably a little bit unfair, but I think like to the 16th century or something like that, with 17th century, with joint stock companies and sending John Cabot across the Atlantic to discover Canada. So yeah, it has an interesting history. I'll let you carry on here, Steve.
Sure. So pass-through entities, again, talking about what makes some sense in the US. We talked about some of the concerns for Canadian residents investing through limited liability companies. Those same concerns extend to the other alphabet soup of entities we see in the US. Sometimes you'll see these things called limited liability partnerships, or LLPs. You'll often see limited liability limited partnerships, or LLLPs. All of these things, these types of entities, are considered corporations for Canadian tax purposes. There is a US partnership that is considered a partnership for Canadian tax purposes and has advantages in Canada, and that's just a plain limited partnership, or LP. And so a limited partnership in the US, in general terms, you're going to be able to match whatever the income, the gain characterization, or any other characterization of income is going to be generally the same between the two countries. Your timing of tax paid between the US and getting a credit in Canada is going to be similar. To the extent that you've got, for example, you see this a lot in real estate, and to the extent that you can argue that the sale of the property is going to result in a capital gain, that capital gain would be a similar characterization in Canada as well as the US, and you get lower tax rates as a result. If foreign property, the partners would have limited liability. They would be limited partners in the partnership. The limited partnership needs to have a general partner, and that general partner would have unlimited liability. And the typical scenario you'll see would be a corporation that would be the general partner, that would have a fairly minimal interest in the limited partnership, usually 1% or something less. All the limited partners would own shares in that corporation, and that would prevent, in general terms, again, a legal issue, that would ensure that the partners themselves are protected from liability, and their only exposure would be the amount of money they invest. And so a limited partnership makes a lot of sense, particularly when it's real estate in the US. There can be other businesses that it might make some sense as well. When you've got US partners and US colleagues in your business, a US resident investor, in general terms, is going to be indifferent between using a limited partnership or a limited liability company or a limited liability limited partnership. They're going to be indifferent from a tax perspective because the tax results are the same. It's all a flow through to them. And so from the Canadian perspective, to the extent that that Canadian investor has an influence, has enough of an investment that they can change or suggest or influence the type of entity used, we'll often encourage those investors to use limited partnerships in the US. Another consideration would be for a US citizen to use something called an S corporation. We talked a little bit before that these are just regular corporations under US law that have a special election under the Internal Revenue Code to treat them as something called an S corporation or a flow through. And so there can be advantage here for US citizens who are resident in Canada to use an S corporation for their US business, and not only make the S corp election for the US, but then make something called an Article 29 election under the Canada-US Income Tax Treaty. And that's a very specific provision that allows shareholders in S corporations to treat the income for Canadian purposes as something called foreign accrual property income, or FAPI. Warren mentioned that before, and you'd say, well, why would you do that? Well, what happens under Canadian law is that if you have just a US corporation, and if it's paying tax in the US and then making distributions, if you don't do anything, Canada's going to tax it differently under Canadian law than you would in the US, because Canada's only going to tax the cash that comes out as a dividend. There's going to be a restriction on the amount of foreign tax credit you can claim. You're going to end up paying higher tax overall. And if you can't get the timing right between the income that's taxed in the US in the year and the cash that's taxed in Canada, you could pay tax twice on the same income. The Article 29 election allows you to match the income and the timing so that when the company earns income in the US as a tax in the US, the same amount of income is also taxable in Canada at the same time, and you're allowed to claim a full foreign tax credit for any US federal and state tax you pay. More importantly, when you go to take cash out of that S corporation, the cash is tax-free in the US because it's already been taxed once. It's also tax-free in Canada if you make this election. And that's the real win by making this election. It's a formal process. You've got to actually go through the competent authority with Canada to make the election. There's an agreement you'll sign. They want proof of the corporation's existence, that you made an S corporation. In general terms, this has to be a US business. It can't have any significant Canadian activity to it. Otherwise, you wouldn't be able to make the election. There's a whole host of requirements to meet. But in certain circumstances, for US citizens resident in Canada with a US business, this election and strategy can make a lot of sense.
So I'm presuming our viewers are looking at this and saying, hey, Warren and Steve, you've talked about a whole bunch of things here. What's the magic bullet? What's the magic bullet? There's got to be a magic bullet here that solves the problem instantly. No, unfortunately, there's really not here. It's a question of, what your business is, how is it owned, what you're doing, and how can you minimize. The goal here is not to reduce your US tax, not to reduce your Canadian tax. It's to reduce your overall tax. And so in every situation, you got to say, how can I best do that? What you generally don't want to have, let me back up. What you want to have is you want to have a situation where if you're going to pay US tax on it, you're paying Canadian tax at the same time. Now, you may not pay US tax or Canadian tax on everything because generally Canadian tax rates are higher. So we want to take advantage of deferral opportunities, but we want to also make sure generally that one of the secrets here is to reduce or eliminate US tax liability that arises from activities in Canada. Because we know that if we pay US tax now and pay Canadian tax later, we'll end up with a double tax situation. So to the extent we can pay enough Canadian tax now, personally, to offset the US tax effects, that's where you start getting that kind of matching principle we've mentioned a few times here about matching income and recognition in both Canada and the US at the same time. And any of these entities can do that. The ULC can do that. The limited partnership can do that. The S corporation can do that. The C corporation can do it. Do they do it perfectly? No. Do they require some attention? Yes. Does it depend on the nature of the income you earn? Yes. Does it depend on ownership? Yes. So there's a whole bunch of variables in here to say what works best. And that's going to be very much dependent on the circumstance that you as the viewer are involved with, and how we can get the best result in those situations. Steve, I don't know if you had any comments on that, and just about what's the best choice here.
It's a little bit, everyone's situation is different. You've got to take this information and go through our strategies. And I think people are going to make different decisions based on what's presented. I had a recent situation a couple of years ago where it was a U.S. citizen coming to Canada. They had a business. We went through all this. We came up with a strategy, and we looked at the complexity. We talked about the cost. We talked about all the different rules. And the individual came to me and said, well, what if I just sell my business before I come here and just take a salary? I said, well, that's a choice. If you think simplicity is easier than some of these complex solutions, that might be a great choice for you. But I think the important thing is to understand that there are complexities, there are considerations, there are the wrong way to do it, there's the right way to do it. You take that information and say, okay, what makes the best sense for myself? So there isn't any one right answer, and sometimes those answers can really surprise us in certain circumstances.
Yeah, one thing you want to make sure you avoid for sure is you don't want to end up in a situation where the only winner is your tax advisor. Like that's not a win. Our goal is to create value for our clients, not to create value for us. We, of course, hope we do a great job for you, and you appreciate that. And but it's got to be, at the end of the day, it has to be a win for you. And so you have to think in terms of magnitude here too. What I wouldn't say is this, and this is regardless of whether you're a U.S. citizen or not, you don't want to incorporate your business activity to defer tax if you're paying all the income out of the corporation to yourself anyways. There's no tax deferral associated with that. You need to make sure the amount of tax deferral is actually enough, that there's enough of a deferral there and a win that you not only have a tax advantage, but it covers the costs associated with managing this from a tax perspective. And we've indicated there is a cost associated with that. So, it has to be more than nominal. Now, people ask, particularly after the 2017 tax reform, that was the Trump tax reform that brought in the GILTI rules. The controlled foreign corporation rules actually go back to John F. Kennedy. I'd love to say I knew when that happened, but I was 6 years old at the time. So I don't recall that. But they've been around for a long time. The PFIC rules come out with Ronald Reagan. I was actually practicing at that point in time. That was 1986. So that probably just says a lot about me. So, these rules have been around for a while. And but the GILTI rules in particular, a lot of people came to Steve and I and our other partners and team members said, should I even be incorporated? Well, the answer is still yes, but what has happened, it's raised the bar because the additional costs you'd incur associated with that. So would I incorporate if I was going to defer tax on $10,000 in my using a corporation? No. You might do it for other reasons. Remember, we said that limiting your liability was a critical issue. And Steve also mentioned about income splitting. That could also influence that decision. But for $10,000 of income in that corporation, I wouldn't do that for that level, not for tax purposes, if that's the only reason. What's the threshold? Well, that really, that's going to be different for every person, but you want to make sure it's substantial enough that it really makes a difference there. And this is a key part, and that's where that kind of tax planning comes to the picture. So I'll move on to talk about U.S. tax reporting. And we've got Form 1120, 1120S here. That would only be involved with either a C corporation, that's the 1120, or the 1120S is for an S corporation. There's some other variations we can talk about, but they go beyond this class. The forms I really want to focus on are those last four, because anytime a US citizen or green card holder has an interest in a non-US entity, they're going to end up with disclosure obligations. And those can go from moderate to significant. Probably one of the most significant ones today is the 5471. It's ballooned to, it used to be 6 pages, I think. And now I don't even know how many pages it actually is. I think it can balloon to over 20 pages here because there's a bunch of schedules attached there. And this is one of the ones where it's say, if you're a US citizen in Canada and you have an interest in a controlled foreign corporation, you're not disclosing it, it's a $10,000 penalty here. And it's $10,000 per year per occurrence. It can also, I think, go up to $500,000 in certain circumstances. And the penalties can escalate wildly here. The US always carries a big stick when it comes to tax penalties. The good news is here, if you do have a controlled foreign corporation, you haven't disclosed it, you may be eligible for one of the US, what they're generally called as amnesty programs. The most common one here is the streamlined filing requirement or procedure, and that may make life a lot more simple for you. So anytime you have a non-US corporation and it's a controlled foreign corporation, you have a 5471 obligation. Now, I don't know if it's important there in sequential order, but Form 5472 is also a significant form here, mostly because the minimum penalty is $25,000 and the IRS is automatically assessing that penalty. It deals with non-arm's length transactions. There's some very specific requirements associated with it, particularly if there's a US business activity associated with that. So Form 5472 has some significant penalty obligations associated with it too. IRS Form 8858, that is deals with disregarded foreign entities. That's something like the unlimited liability company requires disclosure there. If you have a interest in a non-US partnership, it's Form 8865. There is a laundry list of other forms. We didn't include the ones for PFICs, past foreign investment companies. All these have penalties associated. If you don't file them and you're required to do so, they'll suspend the statute of limitations indefinitely. So, you could be, if you don't file a return, you may have long-term exposure in that too. So there's significant issues there. Steve is going to talk about Canadian tax reporting and some of Canada's special rules here too.
Sure. So similar to the US, Canada wants to know information not only about its domestic activities, but anytime there's activities outside of Canada's borders. There's a select amount of returns here. There's more to it than that. We've selected a few. So a Canadian corporation, whether it's a regular corporation or an unlimited liability company, on an annual basis, it's going to file Canada Revenue Agency Form T2. It's a corporate tax return. If it's a limited partnership in Canada, it would file a partnership tax return, and that's typically due within 90 days after the end of the fiscal year. In addition, if an individual in Canada or if a Canadian corporation has what's called a foreign affiliate, if it's got an interest in a US corporation, an S corporation, an LLC, or even just a US regular corporation, Canada wants to know details about that. So there's some what's called foreign affiliate reporting. And starting with the 2021 tax year, that form has been expanded. So there's a lot more information that Canada Revenue is asking for. They're asking a lot more questions. They're asking you to calculate certain accounts and pools and surplus accounts. And so it's a lot more involved. In addition, where you've got transactions between these Canadian and US entities, and if those transactions in the year exceed $1 million Canadian, then there's some transfer pricing disclosure called Form T106, similar to some of the ones Warren was talking about. Canada wants to know what those transactions are and what transfer price they were done at. Is it cost plus? Who was it done with? And so, extensive reporting. Penalties, yes, not as high as some of the US penalties, but the penalties exist. amnesty program if you failed to do this on a timely basis. Yes, Canada Revenue's got a voluntary disclosure program that's something that you could fulfill and try and waive the penalties if you meet certain criteria. So I think we are at the end of our formal presentation. We've left about 10 minutes or so for questions, and we'll get to some of those. We ask that you complete the survey. We've done, I'm not sure how many of these done, like 10 or 12 of these, and a lot of the ideas for these webinars come from you. So if you've got future topics you want to see, please complete the survey. Any other suggestions you have, the closed captioning option, I think, came from one of the survey comments a few months ago. We'd like to hear from you. We've got two of our managers with us here, Lena Samin and Lei Zhao, who are gathering your questions, and I'll turn it over to them to feed us a few.
Thank you, Steve. Thank you, Warren. Thank you for the presentation. We received a few questions, and some questions are with the unique tax situation. We probably will address the questions in a wider breadth. So here's the first one. For equity issuance for executives who are U.S. citizens and joining new ventures in Canada, can that trigger things like PFIX or other issues? Should they incorporate, or could this equity be held personally?
I'm happy to answer that. So for U.S. citizen executives in Canada, oftentimes they'll be given some sort of stock compensation or equity ownership in the company they're involved in. And where it qualifies as a passive foreign investment company, that can subject them to reporting requirements, the higher tax on sale, the interest charge. It really depends on the nature of that investment. And oftentimes it can be an active company, and you may think that it's not going to be a passive foreign investment company, but oftentimes startup companies, high tech, biotech, that raise a lot of money, that don't have a lot of revenue, will have investment income from the cash they've raised, and that, you know, little bit of interest income can trip them over and make it a passive foreign investment company. There are solutions to that that don't necessarily involve forming it in another entity or a trust or limited partnership. There's elections that those U.S. citizens can make to treat the investment under different rules that are going to lower the tax rates. Our webinar that we conducted a month ago has some of those solutions, and so I'd encourage you to go to our YouTube channel and view that.
Okay, Warren, do you have anything to add?
Nope, I think that's great. I would discourage people from creating an entity to hold another entity, especially a Canadian entity, and those won't solve your PFIC problem. If the entity issuing the stock is a passive foreign investment company, that's not going to help.
Thank you. The next question is, outside of the unlimited liability, why would a U.S. person not have a ULC?
Why would outside of the unlimited liability?
Yes.
Well, in some cases, in some cases, if like particularly professional association will not permit someone to incorporate their architectural practice and use a ULC because the architects of Canada or the of British Columbia, the association doesn't allow that to take place. I know some of the medical groups, I think the BC Medical Association does not allow you to use a ULC yet. So you may not have a choice there in terms of the entity you might use.
Yeah, it's an interesting question. I think, you go back to Warren's comment earlier about complexity and cost. If you're not going to get the advantages of using an unlimited liability company, and those advantages, are probably restricted to either some amount of income splitting you might be able to achieve that meets the requirements under the Canadian legislation, or the big advantage is the lower corporate tax rates that one can achieve by using a Canadian corporation or an unlimited liability company. If those two things you can't fit in or you don't take advantage of those, then just forming an entity is just going to add costs, legal costs, accounting costs, tax reporting costs without any benefit. You might want to just consider a self-proprietor, just your own income. So you got to get advantage of these things because there are costs associated in operating them.
Thank you. We have a couple more questions. So the next one will be, generally, dividends earned in the U.S. are sourced to the U.S., but U.S. capital gains are sourced to Canada in filing Canadian and U.S. returns for U.S. person living in Canada. Does earnings in these types of income through U.S. partnership or trust change that?
I think I can step in here. So if you use trusts, I'm going to kind of stay away from trusts because trusts have some aspects here that are problematic. I'll just say that in that running a business through a trust does not result for U.S. tax purposes in tax as a pass-through entity. It'll be taxed as a corporation. But with regards to partnerships, if for example, a partnership holds U.S. real estate and there's a capital gain because the real estate is sold, that's U.S. source income. But if the partnership holds shares of Apple, a U.S. corporation, or shares of TELUS, a Canadian corporation, when the partnership sells it, this is a U.S. partnership, when it sells it, it's still Canadian source income where the partner is a Canadian person. So it's sourced to that income. So using an entity like a partnership doesn't change the sourcing of that income. If you sell shares of a U.S. corporation, it's going to be sourced to Canada with one exception, and that's if it's a U.S. real property holding company. That gets into the FERPTA rules, which we haven't talked about here. So, Leigh, I think I got the drift. I don't know, Steve, if you had anything else you wanted to add on that.
It's I think that the challenge on sourcing of different types of investment income is always making sure it's modeled out to say, okay, I'm going to pay U.S. tax and Canadian tax. Can I use these two? Can I use the one credit against the other, and making sure that my overall taxation is the same? I mean, everyone's situation is a little bit different, but one should be modeling out that investment portfolio and making sure that's the right structure.
Yeah, just one other comment on it. I mean, to the extent someone uses, whether it's a U.S. partnership, a Canadian partnership, a partnership in the Caymans or somewhere else, the fact that there is a partnership in there does not generally affect the source of the income that the partnership receives that then is attributed to the partner. So if I'm a partner in Canada, I'm a U.S. citizen, and I receive investment income from Switzerland through my partnership in the U.S., it will be the dividends from Switzerland will be taxed as Swiss source, even though they're coming from a U.S. partnership. And if there's a capital gain, it'll be Canadian source because I'm a resident of Canada. So, we see these sort of investments much more common with our clients in the last 5 years, that they've got, BVI partnerships and other partnerships outside of Canada and the U.S., which have a variety of different types of income.
We're just coming on the top of the hour here. I want to thank everyone for joining us. Leigh, we've got time for one more question here.
Okay, the last one will be, if you are a dual U.S. Canadian citizen and you own a U.S. C corporation, it's a T1134 generally required.
Sure, I can answer that. So in general terms, if it's considered a foreign affiliate or a controlled foreign affiliate, then that Canadian resident owner would have to file an information return of Canada Revenue called T1134. You need to look through the definition of foreign affiliate and controlled foreign affiliate. In general terms, anytime there's a 1% ownership or more, you want to start looking at all the different rules and requirements to see if it is a foreign affiliate or not. I think that wraps up our time for today. Again, I want to thank everyone for joining us. Please complete the survey, and we look forward to seeing you next time.
Excellent.
Thanks,
Thanks,
Warren.
everyone.